Hello friends, I'm Sanjay. In this series, I'm covering the business studies subject from the CBSE Class 12 syllabus. We will be following the standard NCERT textbook for the topics that we will discuss. This is the ninth video of the series and we will cover the ninth chapter, Financial Management, from part B of the subject. This chapter comes under Business Finance in part B. So first we will have to understand what is the meaning of business finance. In simple words, business finance refers to the management of the money required to carry out various business activities. If you wish to start a business, almost all business activities will need finance, like for establishing a business, for running the day-to-day operations, and after a few years, you will need money for modernizing the business, for buying new machinery, for expansion, for diversification. So all of these will require money. Money is used for purchasing assets. They can be tangible assets like machinery, factories, buildings, offices, or intangible assets like trademarks, patents, technical expertise, etc. Money is also crucial or necessary for running the daily operations of the business, like for buying materials, for paying bills, for paying salaries, which means that adequate finance or adequate money is essential for the survival and growth of a business. And the process of managing all the financial aspects of a business is a part of business finance. Business finance includes the planning, procuring, management, and allocation of funds and resources to support a company's operations, investments, and growth. So, what is financial management? Managing the finances of a business is financial management. Financial management involves the careful handling of the finances of a business, since all finance comes with a cost. There are two main aspects of financial management: optimal procurement, which is identifying and getting funds from the best possible sources, and optimal usage, which is using the funds in such a way that they generate the best possible returns. What are the aims of financial management? Reducing the cost of funds, keeping the risks under control, ensuring efficient use of funds, and ensuring that enough funds are available when they are needed, because not having funds when required can cause problems, and also idle funds, that is, having money that is not being used in the business, means that resources and opportunities are being wasted. Financial management directly affects the financial health of a business. For example, even a very well-funded business like Byju's, which raised billions of dollars, is undergoing severe problems because of improper financial management. And the financial statements of a business, like the balance sheet, the profit and loss account, cash flow statement, etc., reflect the financial position of a business. Accurate financial statements will enable the management, the investors, the public, and the government to understand what is happening inside the business without actually having to look into the day-to-day operations of the business. This is the reason why there are accounting standards that need to be followed while preparing the financial statements or the financial reports, and they have to be audited and certified by professional chartered accountants. What are some of the areas which are affected by financial management? Which is another way of saying what are the areas which are covered or influenced by financial management. First is size and composition of fixed assets. For example, a decision to invest 100 crores in fixed assets will increase the fixed assets by that amount. Quantum or amount of current assets such as cash, inventory, receivables, because financial management will affect decisions on credit and inventory, which will impact debtors, inventory, and current assets. Amount of long-term and short-term funds, because financial management decides the proportion of long-term versus short-term funds. For example, a business may choose more long-term funds like a loan for higher liquidity, even though short-term funds like an overdraft may cost less. Breakup of long-term financing, that is debt versus equity. As we will discuss later in this chapter, decisions on how much finance comes from debt, equity, or preference shares are also part of financial management. Profit and loss account items such as interest and depreciation are all affected by financial management. More debt results in higher interest expense. More equity may require higher dividend payments. And business expansion affects almost all the items in the profit and loss account. In short, financial management affects almost all aspects of a business, either directly or indirectly. What are the objectives of financial management? Suppose I take a loan from a bank at a 10% per annum interest rate, and I invest that money in a project that gives me 20% returns. Then, even after paying the 10% interest, I will still make a profit of 10%. Suppose I can get a loan at an interest rate of 8% per annum. Then my profit will increase to 12%, which means that the difference between the cost of funds and the returns generated by using the funds is the profit for the business. So, good financial management is required to ensure that the mobilization of finance happens at lower costs, that is, to get money from the cheapest possible source. And the investment happens in the most profitable activities. That is, to invest the money in those activities which can generate the highest profits. One very important objective of financial management is to maximize the shareholder wealth, which is also called as wealth maximization concept. By maximizing the profits of the business, financial management will increase the shareholders' income. But more importantly, if the company is publicly traded, that is, if the shares of the company are listed on a stock exchange, the increased profitability will also increase the share price. To summarize the wealth maximization concept, the objective of financial management is to source funds from the cheapest possible source and to use the funds for activities that generate the maximum possible returns, which will directly increase the profits or the earnings per share for the shareholders. And the increased earning per share will also increase the market value of the shares, maximizing the shareholders' wealth. When it comes to money or finance for a business, there are three questions that need to be answered. The first one is, why does the business need money? What is the purpose? The second question is, what should be the source of the money? And the third question is, should the profits generated by the business be retained for further investments or as reserves, or should the money be paid out to the shareholders as dividends? Deciding why the business needs money is an investment decision. Deciding what will be the source of the money is a financing decision. And deciding whether to retain the profits or pay it out as dividends to shareholders is a dividend decision. These three decisions are called financial decisions. Investment decisions may be about investing in long-term investments like land, building, machinery, or other fixed assets, which is also called as capital budgeting. Or investment decisions may be about investing in short-term investments like how much cash to have, how much inventory to keep, or what should be the levels of the receivables, that is money that is receivable from the customers. These are also called as working capital. Financing decisions about what should be the source of the money may be about deciding whether to raise money through shareholder funds, which can be either share capital or it can be by retaining the profits without paying dividends, or the money can be raised through borrowings such as loans, debentures, or other forms of debt. For shareholder funds, there is no interest to be paid and there is no obligation to return the money. Whereas for borrowed funds, there is an obligation to repay the principal amount and also to pay interest. Dividend decision may be about whether to distribute the profits to the shareholders as dividends or to retain the profits for reinvestment, for expansion, or as reserves. The focus of this chapter, financial management, is on these three decisions. Investment decisions are the first type of decisions in financial management. For making investment decisions, we need to understand, why does the business need the money? Will the money invested through the business earn higher returns than the cost of the funds? The business may need money for long-term investments like land, building, machinery, and other fixed assets. These decisions are called capital budgeting decisions. The business may also need money for short-term investments like maintaining some levels of cash, some levels of inventory and receivables. And these decisions are called working capital decisions. Long-term investments must be based on factors like expected return on investment or ROI, risk assessment of the business and the project, the cost of capital, strategic fit, time horizon, economic and market conditions, technology and innovation, competitor actions, tax implications, environmental, social and governance considerations, human resources and talent needs. Short-term investment decisions, which deal with the levels of cash, inventory and receivables, affect the day-to-day working of a business, the liquidity and also the profitability of the business. So, efficient cash management, inventory management and receivables management are essential ingredients of sound or good working capital management. What are some of the factors affecting both capital budgeting and working capital decisions? The first is cash flows of the project. The expected cash flow affects the liquidity of the business, and a timing mismatch between the expected cash flows and the expected need for funds may jeopardize short-term operations. For example, if you take a loan from a bank that is repayable in 1 year, but your business will start generating cash only after 2 years, then there is a mismatch. So, your investment decision should be based on whether you will be able to balance between the expected cash flow and the expected need for cash. Rate of return. The expected rate of returns should be calculated to assess the viability of the project and also to select between alternative options of funding. For example, if you take a loan at 10% per annum interest and invest it in a business that will give you 8% returns per annum, there is a mismatch because you will definitely make a loss. So, you should invest in that business only if you can get funds at a rate which is significantly lower than the expected rate of returns. And also other investment criteria, which includes factors like the amount of investment, is it worth the risk, build or buy options, do you need to start a new business or should you just buy an existing business, and concentration or diversification risks should also be considered while making investment decisions. In short, investment decisions will decide why do you need the money and is the project or the business worth investing in. Financing decisions are the second type of decisions in financial management. In the first type of decisions, that is investment decisions, you have decided that yes, the business needs the money. In the financing decision, you need to decide on what will be the source of the money. The business can raise money through shareholder funds, that is equity capital or the share capital, or it can be through retained earnings, that is retaining the profits that would have been otherwise paid to the shareholders as dividends. The advantages here are that no interest needs to be paid on this money and there is no obligation to return the money. The business can also raise money through borrowed funds, that is loans, debentures or other forms of debt. Here, timely repayment of the principal is required and also interest needs to be paid on the amount that has been borrowed, which means that there is a risk that if the business is unable to generate enough cash flow or generate enough returns, it may be unable to repay the principal or pay the interest on the loans. This risk is called financial risk. Before making financial decisions, some factors that should be considered are cost, because raising funds through different sources has different costs. The firm should evaluate all the options and should normally choose the cheapest source. Risk. The risk that is associated with each source is different. Debt has the highest risk because principal and interest needs to be paid regularly. And equity has the lowest risk because there is no interest and no repayment of principal. Floatation costs. Higher the floatation costs, such as cost of processing or transaction fees, the less attractive the source will be. Cash flow position. That is a stronger cash flow position. That is, if a business can generate regular and adequate cash, then it may make debt financing more viable and more attractive than funding through equity. Fixed operating costs. If a business has high fixed operating costs, that is building rent, insurance premiums, salaries, etc., which have to be paid regularly, then it must reduce fixed financing costs because the principal repayment and the interest payments will also eat into the cash flow. Hence, lower debt financing, that is, minimizing interest payments, is better. Similarly, if fixed operating cost is less, then more of debt financing may be preferred. Control considerations. Issuing more equity may lead to dilution of the management's control over the business. Debt financing has no such implication. So companies which are afraid of takeover bids would normally prefer debt over equity. State of the capital market. During the period when the stock market is rising, called the bull market, more people invest in equity or shares at a premium. So raising money through shares is more beneficial for the company. However, depressed capital market, called the bear market, may make issue of equity shares difficult, and it will be less lucrative for any company. So all of these factors have to be considered before deciding whether to raise money through equity or through debt. Dividend decisions are the third type of decisions in financial management. In the first decision, that is investment decision, you have decided that yes, the business needs money. In the second decision, that is financing decision, you have decided whether to raise the money through debt or through equity. And after you have invested the money, the business generates profits. In the third decision, that is dividend decision, you need to decide what to do with the profits. Should the business distribute the profits as dividends to the shareholders, or should the business retain the profits to reinvest it somewhere or keep it as reserves? What are some of the factors affecting dividend decisions? Amount of earnings, because dividends depend on current and past earnings. So higher earnings will allow for higher dividends. Stability of earnings. Companies with stable earnings year on year are better positioned to declare higher dividends. Stability of dividends. As a policy or as an obligation, some firms may need to maintain a steady dividend per share every year, depending on the sustained earning potential of the company. In such cases, companies will declare some dividend every year. Growth opportunities. Companies with better growth prospects and investment opportunities may retain more earnings because reinvesting the profits will lead to future growth and will eventually increase the market value of the shares, increasing shareholder wealth. Cash flow position, because adequate cash availability is essential for dividend payments, even if the company is profitable. Because if the profits are notional but not received in cash, then dividends cannot be paid out. Shareholders' preference. Management will consider the shareholders' desire for dividends or their desire for reinvestment in growth and decide whether to pay out dividends accordingly. Taxation policy. Higher taxes on dividends may lead to lower payouts and vice versa. So the tax policy of the government at that time will affect the decision on whether distributing dividends is better or retaining the earnings is better. Stock market reaction. Increases in dividends often boost stock prices, while decreases in dividends can negatively affect the stock prices. So dividend declaration can be done on the basis of whether the company wants to affect the share prices positively or negatively for any reason. Capital market access. Large companies with easier access to capital, such as Reliance, may pay higher dividends as compared to smaller firms, because for larger firms it is always easier to raise equity whenever they need more funds, and there is no need for them to retain the profits. Whereas smaller companies may prefer to retain the earnings because raising more funds through equity is difficult for them. Legal constraints. Some companies must adhere to legal restrictions on dividend payouts as specified in applicable laws, and some companies may be required to pay dividends by law. And finally, contractual constraints. Suppose a company has taken a loan, then the loan agreement may restrict dividend payments till the principal and interest obligations are met. So in such situations, companies cannot declare dividends. So these are the factors affecting dividend decisions. The next topic in the chapter is financial planning. What is financial planning? You already know what is planning. On the same lines, creating plans to manage the finances of a business is nothing but financial planning. Financial planning is the creation of financial plans or blueprints for an organization's future operations, ensuring that funds are available when needed. Financial planning forecasts or predicts changes in expenses, revenues, and fund requirements due to decisions like capital budgeting or due to changes in working capital requirements. Financial planning is important because inadequate funds or shortage of funds prevents the firm from meeting its commitments, while excess funds increase costs and may lead to wasteful spending. This chapter is called financial management. So, what is the difference and what is the connection between financial planning and financial management? Financial planning focuses on fund requirements and availability, unlike financial management, which prioritizes maximizing shareholder wealth. So, financial planning has a smaller scope, whereas financial management has a much wider scope. Just like planning is a step and a part of the process of management, financial planning is a step or a part of the financial management process. There are two main objectives of financial planning: ensuring availability of funds when needed, estimating both the amount that is required and the time when the funds are required, and identifying the best possible sources, and also avoiding raising unnecessary resources and using any surplus funds or extra funds efficiently to prevent idle financial resources. If you look at it, the first objective is about effectiveness and the second objective is about efficiency. Financial planning aligns fund requirements with availability and includes both short-term, which are budgets, and long-term planning, that is growth and capital expenditure. Plans typically cover 3 to 5 years, with budgets providing detailed 1-year plans. So this point clarifies that budgets are short-term and plans are long-term, and budgets are a part of the plans. The process of financial planning starts with a sales forecast, followed by preparation of financial statements, estimating internal fund generation, and then determining the need for external funds and also their sources. Now that you know that financial planning is a part of the financial management process, what is the importance of financial planning? Financial planning tackles uncertainty. It helps the company manage uncertainty regarding fund availability and timing and ensures smooth operations. Forecasting future scenarios. It prepares firms for different business situations by predicting various outcomes and creating alternative plans. It helps in avoiding surprises by predicting different future scenarios. Financial planning reduces business shocks by preparing the company for potential future challenges as to what are the type of challenges that the company can face in the future. Coordinates functions. It aligns different business areas like sales and production with clear policies and procedures, because all the departments or functions of the organization can align their activities with a common financial plan. It reduces waste. Detailed action plans minimize waste, eliminate effort duplication, and remove any planning gaps. It connects present and future because financial plans link current operations with future goals. Aligns investment and financing. It ensures continuous coordination between investment and financing decisions. And finally, performance evaluation. It simplifies the performance assessment by setting clear objectives for different business segments. Because there is a plan which can be converted into objectives, goals, and targets. And the performance of the different departments or even different persons can be evaluated by assessing their performance as compared to the plans. Next, let me give you a quick overview of the concepts of equity, debt, and leverage. Equity means the money that has been invested in the business by the owners or the shareholders of the business. Debt means the money that has been borrowed. It can be through bank loans, through overdrafts, or through amounts received from creditors. Financial leverage refers to the proportion of debt in the overall capital. Normally, people will avoid taking loans unless there is an absolute need. But in business, taking loans or taking on debt can sometimes be advantageous and can actually increase profits. Let's take a small example. Suppose there is a business opportunity which can give 10% per annum returns. The owners of company A have 1 lakh rupees of their own funds, which they invest into the opportunity. So this 1 lakh is equity. Because of their 1 lakh investment, they make 10% returns from the business. Because they don't have any debt, they don't have any interest payments. So the complete 10,000 is their profit. In company B, the owners invest 1 lakh of their own money, which is equity. They also borrow 2 lakhs from a bank at 8% per annum interest rate. Now they have 3 lakhs to invest in the opportunity. They also get 10% returns, which is 30,000. But they have to pay 8% per annum interest on the 2 lakh loan, which comes to 16,000. So their profit after paying the interest is 14,000. In company C, the owners invest 1 lakh of their own money, which is equity. They also borrow 2 lakhs from some bank, but they borrow at 11% per annum interest rate. They invest the 3 lakhs. They get 10% returns, which is 30,000. But they have to pay 11% per annum interest on the 2 lakh rupee loan, which comes to 22,000. So their profit after paying the interest is 8,000. In company A, the entire funding has been done through equity. There is no debt, there is no leverage. In company B, the funding is done through 1 lakh equity and 2 lakh debt, which means that they invested a larger amount than company A. And because the interest that they paid on the loan at 8% is less than the 10% returns, they made an additional profit of rupees 4,000, which is more than what company A made. In company C, again, the investment is done through a mix of debt and equity. But here the debt is at a higher rate of interest at 11% per annum, which is more than the 10% returns that they are getting from the investment. So company C actually ends up with less profit than company B, which has invested the same amount of 3 lakhs in the opportunity. In fact, company C makes less profit than even company A, which has invested only 1 lakh. So what we can understand here is that funding through equity alone may not maximize the profits. Leveraging, that is, using a mix of debt and equity, can increase profits. But this will work only if the rate of return from the project or the opportunity or the activity is more than the cost of the debt. If the cost of the debt is more than the rate of the return, like in company C, then the debt will reduce the profits. This is a reason why proper financial planning is required to forecast or to predict what may be the rate of return in a business and what is the best source of funding for the business. It can be either debt or equity. The next topic in this chapter is capital structure. Capital structure refers to the mix of owner's funds, which is equity, and borrowed funds, which is debt. A business can have two sources of finance. It can be through owner's funds like equity share capital, preference share capital, reserves, and retained earnings. Or it can be through borrowed funds like through loans or through debentures, deposits from, not in, but deposits from banks or financial institutions, or through issue of debentures, or through deposits from the public. Financial leverage is calculated as either debt over equity, which is the ratio of debt to equity, or it can also be calculated as debt over debt plus equity, which is the proportion of debt in the total capital. Here we should also touch upon the concept of financial risk. In this context, financial risk simply means the risk that the business may not be able to meet its financial obligations or commitments. If the business does not generate enough returns or there is not enough cash flow, then there is a possibility that the business may not be able to pay interest on the loans that it has taken or repay the principal amount in time. In general, debt is riskier for the business because regular interest payments and principal repayments are obligatory. Equity is considered riskless for the business because payment of dividends or even returning the capital is not obligatory. Debt is also cheaper for the business. And as the financial leverage increases, the proportion of debt in the capital increases and the total cost of funds declines because of the increased use of cheaper debt. But as the debt increases, the financial risk for the business also increases, since the business may be unable to pay the interest or repay the principal in time. As we have discussed, the capital structure of a company affects both the profitability and the financial risk. An optimal or ideal capital structure is the best mix of debt and equity that maximizes profits and maximizes shareholder wealth. And capital structure is decided on the basis of the opportunities available to the business, the possible returns that can be generated, and the cost of debt. Let us look at an example of how the debt or leverage can affect profitability and earnings per share or EPS. Suppose there are three businesses A, B and C, all of which have a total capital of 30 lakhs each. In business A, the entire 30 lakhs are invested by the shareholders. So there is only equity and no debt. In B, 20 lakhs is equity and 10 lakhs is debt. And in C, 10 lakhs is equity and 20 lakhs is debt. The equity in all these three companies is in the form of shares of 10 rupees each. So the number of shares will be equity divided by 10. The returns generated by the companies from their business at the rate of 13.33% on the total capital is 4 lakhs each, which is the earnings before interest and tax. Because there is no debt in business A, the interest payment is 0. The entire amount of 4 lakhs becomes earnings before tax. Income tax is 30% on earnings before tax. So income tax comes to 1,20,000. So the earnings after tax is 2,80,000. And since there are 3 lakh shares, dividing the earnings after tax by 3 lakhs gives us 0.93 as earnings per share. In business B, there is a debt of 10 lakhs. So the interest on debt will be 1 lakh. Earnings before tax will be 3 lakhs. Income tax at 30% on EBT will be 90,000. Earnings after tax will be 2,10,000. Dividing this amount by the number of shares will give us an EPS of 1.05. In business C, there is a debt of 20 lakhs. So the interest on debt will be 2 lakhs. So EBT will be 2 lakhs. The income tax will be 30% on the EBT, which will be 60,000. Earnings after tax will be 1,40,000. Dividing the EAT by the number of shares will give us an earning per share of 1.4. As you can see here, by increasing the debt and the leverage, the earnings per share have also been increased, which means that the shareholders actually earned more per share by actually investing a lesser amount of their own money. But this will work as long as the cost of debt, that is the rate of interest on debt, which is 10% here, is lower than the rate of returns that are generated by the business, which is 13.33% here. If the details like the total capital, the amount of equity, the amount of debt, and the rate of interest on the debt remain the same as in the previous example, but the rate of return, that is the earnings before interest and tax, is now 6.67% as compared to the 13.33% in the previous example, then you can see that the earnings per share will actually decrease as the amount of debt increases. This is because the cost of debt, which is the interest on debt, which is 10%, is higher than the returns generated from the investment. So in this example, higher amount of debt means higher amounts of losses. The learning from these two examples is that factors like cost of debt and the earnings that can be generated from the investments should be carefully forecasted or predicted before deciding the capital structure of the business. In the textbook, there are 14 factors that are listed as affecting the choice of capital structure. The first factor is cash flow position. Firms must evaluate the projected cash flows before deciding on the debt levels. The cash flow of the business must be able to take care of the requirements of the normal business operations and any essential investments in fixed assets, and also debt servicing commitments, which is cash for interest and principal payments. If the cash flows are not adequate to cover all of these, then the amount of debt should be minimized. Also, some buffer cash should be maintained to take care of any unexpected increases in cash requirements due to various reasons. The second factor is interest coverage ratio or ICR, which is just a ratio which measures how many times a company's earnings before interest and tax, that is EBIT, cover its interest obligations. The formula for ICR is earnings before interest and tax divided by the interest payable on the debt. A higher ICR is always better because it shows a lower degree of risk of not being able to meet the commitments. However, ICR is considering only the interest to be paid and not the principal amount to be repaid. So, ICR is not a complete or the most accurate measure. Also, earnings before interest and tax may be high, but if the cash flow is not adequate, even with high profits, a company may not be able to make the interest and principal repayment in time. So, ICR may not be the best measure of financial risk. The third factor is debt service coverage ratio or DSCR. Debt service coverage ratio evaluates the firm's ability to service its debt, considering both the interest to be paid and the principal to be repaid. The formula for DSCR is the sum of the profit after tax plus the depreciation plus the interest received plus non-cash expenses divided by the sum of the preference dividend plus interest payable plus other repayment obligations like the principal on the debt to be repaid. A higher DSCR indicates better capability to meet the cash commitments. And if a company has very good DSCR, then there is a potential or a possibility to increase the debt in the capital structure. Debt service coverage ratio takes care of the deficiencies referred to in the interest coverage ratio, ICR. So, DSCR is better than ICR. The fourth factor is return on investment or ROI. As we have seen in the examples that we discussed earlier, a higher ROI allows firms to use debt effectively to increase the earnings per share. If ROI is greater than the cost of debt, then using debt is profitable. If ROI is less than the cost of debt, then any increase in the debt will reduce the earnings per share. Another term that is used in this context is trading on equity, which simply means leveraging debt or taking on more debt to enhance the returns for the equity shareholders. The fifth factor is cost of debt. The cost of debt is the interest payable on the debt. Lower interest rates make debt more attractive, and firms with access to cheaper debt can increase the proportion of debt in their capital structure as long as the cost of debt is lower than the return on investment. Companies which are in a strong financial position can secure loans at lower costs, which is another way of saying that if a company does not need loans, then it will get loans at a better rate of interest than a company which actually needs loans. The sixth factor is tax rate, which is the rate of corporate income tax. There is something called a tax shield effect. Because the interest on debt is tax deductible, tax will reduce the effective cost of debt. So, higher tax rates may increase the attractiveness of debt financing. For example, at a 30% tax rate, a 10% interest rate on your debt will effectively become 7%. The seventh factor is cost of equity. In simple words, the cost of equity is the returns expected by the shareholders. If the business has a high level of debt, there is an increase in the financial risk. Because that risk is ultimately being taken by the shareholders, they will seek a higher rate of return on their investment in the company. So, the rate of return expected by the shareholders is the cost of equity, and it may increase if the financial risk increases. Optimal debt level means using debt up to the point where the cost of equity remains acceptable. Suppose if the cost of debt is 10%, which is the interest payable, and the cost of equity is 8%, then equity is preferable. If shareholders are expecting anything more than 10%, which is the cost of debt, then it will be more cheaper to take the debt. The eighth factor is floatation costs. When you take a loan from a bank, they will charge a processing fee. Similarly, raising equity capital also comes with various expenses. So floatation costs means the expenses that are incurred when raising new funds. For example, underwriting fees, legal costs, processing charges, commissions, etc. Higher floatation costs makes a financing option less attractive. For example, if the company has to pay a higher processing fee on a loan as compared to the cost of raising equity, then loans become less attractive. Typically, debt may have lower floatation costs as compared to equity. The ninth factor is risk considerations, which means that the company has to consider all of its risks or the total risk before deciding on the capital structure. Financial risk is the risk of defaulting on fixed financial obligations. That is, not being able to pay the interest on the debt or not being able to repay the principal or not paying dividends. This risk increases with higher debt levels. Business risk is associated with higher fixed operating costs, like if the company has to pay high rent or high amounts as salaries. Higher business risk limits the capacity to take on more financial risk. And firms with lower business risks can afford to take higher financial risk, which means that they can take more debt. The 10th factor is flexibility. Suppose your credit card has a 5 lakh limit. It doesn't mean that you have to regularly keep spending that much. If you regularly keep maxing out your debt limit, then you may not have the flexibility to borrow when you really need money for any emergencies. Similarly, companies will also have a debt limit. And companies should avoid maxing out on their debt capacity. Preserving some borrowing power allows for handling of unforeseen expenses or taking advantage of any unforeseen opportunities. Over leverage risk means that excessive debt reduces financial flexibility. The 11th factor is control. Issuing new equity, which is releasing more shares, may dilute existing management control. Debt financing does not dilute ownership, so it does not affect the control by the existing management. But more debt adds to financial obligations. So, depending on the management's preference, firms may prefer debt to retain control, especially if the current ownership or the current equity level is minimal. The 12th factor is regulatory framework. This simply means that there are various laws, rules and regulations that a firm has to follow before raising capital, either through equity or through debt. Typically, there are more restrictions on raising equity capital as compared to raising debt capital. So, firms may opt for those financing methods which have the least number of or the fewer regulatory hurdles. The 13th factor is stock market conditions or market sentiment. In bull markets, when stock prices are increasing, it is easier to issue equity at favorable prices, and companies may prefer equity financing. In bear markets, when share prices are going down, it is difficult to attract equity investors, so firms may lean towards or prefer debt financing. Timing the market means aligning the firm's financing decisions with market conditions to optimize capital raising. That is, waiting for the right time to raise more capital. The 14th factor is capital structure of other companies. If there are several other firms that are engaged in the same business activity, then firms may benchmark the capital structure against other similar companies, because all of them are operating under the same business conditions and are facing the same risks. But blind imitation should be avoided. Firms must consider their own unique business risks before deciding the capital structure. And any significant deviations from industry norms should be justified based on firm-specific factors. The next topic in this chapter is about management of fixed capital and working capital. So we have to understand what these two terms mean. We know that every business needs funds or needs money for its assets and its activities. Fixed capital refers to the long-term assets and the long-term investments that a company uses to generate revenue. Examples of fixed capital are the plant and machinery and the other equipment used in the business, land and buildings, vehicles, furniture and fixtures. These fixed assets are not consumed or sold during normal business, but they are essential for the production of the goods or services that are actually sold by the business. Fixed capital is typically tied up in physical assets that have a useful life of more than 1 year, and fixed capital is not liquid. Fixed capital assets lose value over time due to wear and tear, which is accounted for through depreciation. For example, a machine used in a factory may have a useful life of 5 years, after which it has to be replaced, which means that every year the machine will depreciate and its value will eventually become zero, or it will reach scrap value after 5 years. Fixed capital assets require a large initial investment to acquire, like the money that is required to buy land or buildings. But the benefits of fixed capital assets are reaped over a longer period of time. Working capital refers to the short-term assets and liabilities that a company uses in its day-to-day operations. Examples of working capital are cash, inventories, bills receivable, and debtors. Now, working capital is the difference between a company's current assets like cash, inventory, and receivables and its current liabilities like payables and short-term loans. A simple formula to remember how to calculate working capital is working capital is equal to current assets minus current liabilities. In simpler terms, working capital is the money that a business needs to run its day-to-day operations, ensuring liquidity to pay its bills and continue operations smoothly. To summarize, fixed capital is essential for long-term investments in the infrastructure that keeps a business running, whereas working capital is necessary for maintaining liquidity and operational efficiency needed for day-to-day activities. Next, let us look at the management of fixed capital and why it is important to manage fixed capital. Fixed capital refers to investments made in long-term assets such as land, building, machinery, and equipment. These investments have long-term implications for the business, affecting its growth, profitability, and overall risk. Now, how do businesses make decisions about fixed capital? This is done through something called investment decisions or capital budgeting, which we have previously discussed. Essentially, companies allocate capital to those long-term projects or assets that will drive their future operations. Because these decisions involve large and long-term investments, they must be financed through long-term sources like equity, preference shares, debentures, long-term loans, and retained earnings. This is important. Fixed capital should never be financed through short-term sources, because this could lead to financial instability. Now, let us move on to why fixed capital management is so important. First, fixed capital decisions have a direct impact on long-term growth. The assets that you invest in today will shape the future growth and returns of your business. Making the right choices today is critical for sustaining success over time. Second, fixed capital involves large capital requirement, and these investments often block significant funds. So it is essential to plan and analyze these decisions thoroughly. Any mistakes here could tie up resources in unproductive projects. Third, fixed capital investments carry substantial risk, especially since the sums of money involved here are large, and poor decisions can have a long-term and long-lasting effect on the overall risk profile of the business. And finally, these decisions are irreversible for the most part. Once you commit to a project or a large investment, reversing it or changing the decision can lead to heavy financial losses. So it is crucial to make well-informed choices upfront. In summary, managing fixed capital is about making strategic long-term investments in the business. And these decisions will drive the growth, profitability, and the risk profile of the firm for years to come. So, ensuring that you finance these projects correctly and make thoughtful, well-researched choices today is key. What are the factors that affect the requirement of fixed capital? First is the nature of business. For example, trading concerns will need less fixed capital as compared to manufacturing organizations. Scale of operations. Obviously, larger businesses will require more fixed capital due to their higher operational scale. Choice of technique. Capital intensive businesses will need higher investment in machinery and equipment, whereas labor intensive firms may generally require less investment in machinery and equipment. Technology upgradation. In industries with rapid obsolescence, that is, industries where technology becomes outdated very soon. Here, there is a need for frequent replacement of the machines or the plant that is being used. So, frequent replacement leads to higher fixed capital needs. Growth prospects. Companies with higher growth prospects or higher expected demand will require more fixed capital to expand their capacity. Diversification. Firms diversifying into new industries or new products. For example, if a textile company is starting a cement manufacturing plant, then there will be a need for higher fixed capital. Financing alternatives. For example, if leasing a facility is cheaper than buying a facility, then leasing the facility can reduce the need for large upfront investment in fixed asset. Thus, it will lower the overall fixed capital requirements. And finally, the level of collaboration. For example, collaborating with other businesses to share facilities, such as banks which share ATMs or manufacturing companies which can share assembly lines, can reduce the individual fixed capital requirements for each business. Next, let us talk about the management of working capital. As we have already discussed, working capital is the investment in current assets which are required for the smooth day-to-day operations of the business. Working capital consists of current assets like cash in hand, cash at bank, marketable securities which can be easily sold or converted into cash, bills receivable, debtors, finished goods inventory, work in progress, raw material and prepaid expenses. Net working capital is the difference between current assets and current liabilities. So the formula for net working capital is CA minus CL. A couple of other points to remember are that current assets are more liquid. That is, they can be converted into cash more easily than fixed assets. But current assets contribute less to profits as compared to fixed assets, which means that firms need to balance having enough current assets for liquidity but minimize the current assets for profitability, because current assets provide low returns. What are some of the factors affecting the working capital requirements of a business? First, the nature of the business plays a role. Service industries and trading firms need less working capital as compared to manufacturing firms, which deal with more inventory. Next, the scale of operations. Larger businesses need more working capital because they manage larger inventories and may have more debtors. The business cycle is another factor. During a boom, increased production and increased sales will drive up working capital needs, while a recession typically lowers them. Seasonal factors also come into play. During peak seasons, more working capital is needed due to higher activity, whereas during lean seasons, less working capital is required. Moving on to the production cycle, longer cycles increase working capital needs, while shorter cycles reduce them. Now, credit allowed to customers increases the amount of working capital needed, since the business will have more debtors waiting to pay. On the flip side, credit availed or credit available from suppliers reduces the need for working capital by allowing delayed payments. Operating efficiency is key too. Efficient inventory management and faster debt collection reduces the need for working capital. Availability of raw materials affects stock levels. Freely available materials mean lower stock and less working capital required, whereas any need to maintain high stock levels of raw materials means that more working capital is required. Growth prospects matter as well. Businesses aiming for high growth will need more working capital to meet the increased demand. In highly competitive markets, you might need to hold more stock and offer flexible credit terms, both of which will increase working capital needs. And lastly, inflation, which means that rising prices for materials and labor will push up working capital needs to maintain production. In summary, the working capital requirements of a business are influenced by a variety of factors, from the nature of the business to economic conditions and operational efficiency. All of these factors need to be considered while managing the working capital requirements of a firm. And with that, we have come to the end of this chapter. If you have any questions or feedback, post a comment below. I will see you again very soon in the next part of this series, where we will cover the next chapter. Take care and Jai Hind.